Hi, folks, and welcome to another video here at Street Smart Options. Folks, if you haven't become a member of our free Facebook group, all about how to trade stock options, I don't know why at this point. It is absolutely free. You can find us very easily by going onto your Facebook account, just putting in three letters, SSO. This stands for Street Smart Options. You'll pull up our Street Smart Options group. It's 100% free to join. Why don't you join us there today so you can get some more great tips like the ones we're giving out tonight. So tonight we're going to be talking about option trading tips. And it's really important to understand that above and beyond the fact that Jonathan is really an expert when it comes to stock options, there's a lot of different techniques out there and a bunch of people that are willing to take your money to teach you all kinds of really unique and difficult strategies on how to make money. And a lot of it is really the basics when it comes to us. We've got everything broken down, so it just really makes sense inside of our course. So today, Jonathan's going to be talking about option trading tips, and he's going to go through some stock charts for us to kind of make sure that we understand it and clarify that for us. So Jonathan, take it away.
Yeah, so we're talking about options trading tips, and one of the things that impacts the price of an option the most is the underlying stock price, right? Especially if you're doing a directional trade, it's the underlying, and it's all about the underlying. Then you want to find a chart that benefits your position. So, I wanted to look at some long-term charts just to give you a sense for, some charts are really choppy and some charts are really smooth. This is a chart of IBM, and I'm looking at a 12-year chart. And you can see, in any particular year, the stock is up, it's down, it's sideways. It's really hard, even in the long term and also in the short term. These are 1-year periods here. It's hard to figure out, what is this thing going to do next? So it's a really choppy chart. It's hard to trade a chart like this. You might want to try to trade levels, say, hey, this is a high level, this is a low level, and try to trade in between. But really, it's a difficult chart to trade. And compare that to some other charts. I'm going to look at Bank of America, which is another kind of a choppy chart, long-term choppy chart. And you can see, Bank of America, and you try to trade this chart, and it's the same thing. Of course, we had the financial meltdown in 2009, but then, it bounced back, and then it was down to 2012, then it was up, and then it's been down, very choppy. In the past few years, it's been up and down, hasn't gone much of anywhere. A hard situation to trade. And then we're going to compare that to maybe a chart that is, I'll call this middle of the road trending, right? Middle of the road Facebook, right? Facebook, on the surface of it, you might think that it's, a good company or whatever, but it's an advertising company, and it fluctuates with competition in the marketplace and also their particular problems with their platform, which it's getting saturated. And so, how much more upside is there in the stock? So, but, you could see, it was a choppy stock. Even during this uptrend, it was kind of a choppy stock. It broke its 200-day moving average quite a bit. A little bit challenging to trade this, although it was certainly better than the other two that we just looked at. And then recently, this past year, it's been really hard, right? The Facebook platform is getting kind of crowded, and they're running out of ad space. So now compare that to a chart that is a lot smoother. Let's look at Visa Company, and you can see that over the course of the last 12 years, we had the financial meltdown, right? But since then, we had a consolidation into 2012, and it's been, it's really kind of a smooth chart. It's an easy chart to trade. You really wouldn't expect too many downswings in this uptrending chart. And look at how smooth it's been in the last couple of years, right? It's been really smooth. So, because it's kind of predictable, it's a lot easier to trade this kind of chart, right? It's a relatively smooth uptrend over the long term. And then we'll maybe look at Microsoft. And same thing, Microsoft, since the '09 bottom, it went sideways for a while, but it's it hasn't really fluctuated much, and then it started in this uptrend. It's been uptrending relatively smoothly now, and especially in the last 3 years, it's been a real smooth uptrend. Very easy to trade a stock like this. So basically, my point is, don't make life difficult for yourself. Find stocks in the universe out there that are easier to trade, that aren't whipping around on news events, aren't whipping around on changes in small changes in interest rates like bank stocks, or anticipation of foreign competition, and maybe with some industrial stocks. Find stocks that are easier to trade, and focus on those kind of stocks. And so in this case, like looking at Microsoft right now, how would you benefit from a stock like this? Well, let's zoom in on a time basis, and this now we're looking at the 3-year chart, right? And we could trade this chart basically looking at the 200-day moving average, which is this red line, and actually this is it's the 40-week, which is very similar to the 200-day moving average. And then we also have the 10-week moving average, and you can see how it tracked this 10-week moving average for look at this, it's been like 2 years it tracked a 10-day moving average, and then it got found support at the 200-day moving average, and now it broke to new highs over here. So how would you trade a stock like this from an option standpoint? Well, because it's not a fast-moving stock, it's not something you would just buy like a call option on and expect to make a whole bunch of money on it. But what you can do is trade a spread trade, maybe a bull call spread. And I prefer deep in the money bull call spreads, because then you're not paying for a whole lot of time premium. So I'm not saying right now is the perfect time to enter this stock for a bull call spread. I'd rather it closer to the 50-day moving average. It's breaking to new highs here. It's maybe on the next pullback week could be interesting. If it pulls back a couple of weeks, could be interesting. But here you would buy a stock, and you would buy the spread trade, open the spread trade, and you would maybe buy, if you were to do it right now, for example, you could maybe buy the 105s, and then you could sell maybe the 115s. That might be a little bit stretching it. Maybe the 100s to the 110. And then you'd buy the 100, be selling the 110. You'd be looking at a expiration date, maybe a month out or 2 months out. Let's go look at an options chain and see what that might look like. So let's look at the Microsoft options chain, and we'll pull up the chain. And so we could see that this is, what are we looking at? This is the April. This is 32 days. So we're looking at the Microsoft options chain for April. And so I was talking about doing a bull call spread, where we would buy the 100, and we'd go somewhere in between the middle here, maybe around maybe around 15 3/4, something like that. And then we would sell the 110, and the 110 has more time premium in it. And so we could benefit as this thing closes in an expiration. That time premium is going to go away, and we would basically pocket the difference, pocket the shrink in the time premium, so that the 100 wouldn't shrink very much at all, whereas the 110 would shrink quite a bit. And so without actually doing the math and digging into the bull call spread, but we can do that if we want to. Say we were able to get the 100 for around 16, and say we were able to get the 110, we would be selling that, and maybe we could get that for around maybe 650 or something like that. So we're talking about 650 and 16. And if we go to Street Smart Options and look at the spread calculator for Street Smart Options, and why don't we pull that up? So we're talking about, let's just say we have a portfolio of $500,000 in this case, and we're doing a bull call spread on Microsoft. We could type that in there, and you can kind of see what's going to happen here. The date today is the 17th. I'm going to do the 18th because that's actually a trading day. So we'll put that in there. And what was the expiration on this? I think it was April 18th, as I recall. Yeah, April 18th. So we'll go and we'll put the April 18th expiration in here. and it's 2019. And the high strike is 110, and the low strike is 100. And the price of the high strike option, let's see what that was. The 110, we're going to be paying about, let's see, we're selling it. We'll be selling it for maybe around 630, maybe 650, maybe a little bit better than that. Maybe we can get 675 for it. The better, the more money we can get for it, the more money we're going to make on this thing. So let's say we can get 670 for it. And then the price of low strike option is what we're paying. And we'll look at the low price option. And we're going to be paying maybe about 16 for it, somewhere in that mid-range there. So we'll go back to the calculator. We're paying about 16 for it. Let's see what that pops out to be. So if we had $500,000 portfolio and we just wanted to risk 2% of our portfolio on this trade, we could take in 10 contracts. And the initial outlay is going to be $9,300. That's our max risk, right? And now we control our risk. If this thing doesn't go our way, we'd get out if we're down maybe 20%. So we'd have like a stop loss of about $1,800 on this. So we wouldn't want to take a max loss if things didn't go our way. And then in 31 days, we're going to make about 7.5% on this trade. And I'm going to cough in a second here. Hold on a second. All right, I just muted myself. So, and so on an annualized basis, it's about 88%, which isn't bad. And we were pretty conservative on these. We could actually probably do better than this 6.70 and 16. We might be able to actually get more like 6.9 out of this, and we might be able to, pay a little bit less than this. So we might be able to pay maybe 15.7 or something like that. That makes a big difference, right? You see this now our annualized gain goes 160%. So where we actually get into the spread is really important, and we want to maximize or minimize the amount of our out-of-pocket outlay so we can maximize our annualized gain on this. So, but there's some options trading tips. It's pick an underlying that's easy to trade, and then just pick a high probability trade. A bull call spread on a smooth stock like Microsoft is a high probability trade. And, you could do these kind of trades every month and just pocket, a nice recurring income stream from these things without risking a whole lot. And then you control your risk. You get out of the position if things don't work out, right? You get out with a 20% loss, which happens only once in a while in these kind of trades because these are high probability trades. So you'll be pocketing maybe over the course of a year, 100% plus gains on these kind of trades, and you'll be doing it month after month. So that's the options trading tips that we're going to provide today. Okay, Jim.
All right, Jonathan, thanks for that. So again, folks, if you haven't checked out our course, you can always take a look at us and what we have to offer over at streetsmartoptions.com. And if you're watching this on our YouTube channel and you haven't gone ahead and hit that subscribe button, give that some thought. You might want to subscribe to our videos so that you can get more tips and tricks. And if you hit that bell icon, it'll make sure that you get notifications the next time we put out a great video like this. Thanks, and have a great day.